people too often talk about borrowing from their policy. If you've ever asked yourself, how much sense does it make for me to borrow money from myself? The answer is none at all. Here's the good news though. You're not actually borrowing money from yourself. What you're doing is you're using the cash value and the death benefit inside of your policy as collateral, meaning that you're putting it up as a guarantee to pay back the loan from the insurance company. All you made was the interest payment of $5,000. You would still have a loan of $100,000 due, and you'd owe $5,000 again the following year. All the while, your account value is now $105,000, and if you were earning 5% interest on that, you would earn $5,250, which is $250 more than what you started with. And this is the power of infinite banking. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, we're gonna be talking about whether or not you should run all of your expenses through an infinite banking policy. So my question to you is, should you? Do you believe you should, as an agent, teach your clients to do this? Or as somebody who's looking to utilize infinite banking in your life, if maybe you're trying to learn this, is this something that you think you should do? Yes or no? Now, this is a really complicated question, and there's a lot of hype around this on the internet. Many life agents advocate that you should run every dollar of expense through your policy that you have in your life. Is this a good idea or not? First, I think we need to look at why they say that this is a good idea in the first place. First, I think we need to look at why agents say that this is a good idea in the first place. You get tax deductions, you get to pay yourself interest. These are things that people say a lot, right? Have you ever heard you're gonna get tax deductions, you're gonna get to pay yourself interest, you're never gonna interrupt compounding on your money, you're gonna build a good discipline and follow a good financial system, and ultimately you're not gonna be supporting the banking system. Okay, so I'm a huge advocate of the idea of using whole life insurance as an asset to increase efficiency in your personal finances. And while there are ways you can make paying all of your bills through your policy work, it's important to understand all of the moving parts of the policy before you proceed. So what I'm gonna do now is I'm gonna work this list backwards and break it all down for you. First off, I think it's important to realize the entire playing field of infinite banking. The creator of infinite banking, Nelson Nash, was a hardcore supporter of Austrian economics. And one of the greatest reasons that he loved the concept of using a whole life insurance policy as your bank is due to the fact that he detested the fractional reserve banking system and how it was being used to financially enslave North Americans all over this continent. Utilizing whole life insurance policies as the foundation of your financial life was a great way to get around that. Now, second, let's take a look at the discipline side of it. The facts are, it's hard for people to break habits with money that they have. One could make a strong argument that regardless of the actual financial efficiency of infinite banking, it sets in place a set of rules that forces you to follow solid Austrian economics to implement in your life. So even if you incur a little cost, the system over the long term will more than make up for it. Now, before I get into the next points where the math can get a little bit hazy, it's important to realize the importance of this last point. Human behavior is ultimately what will lead you to or keep you from success with your money. Now, the next major focus on using infinite banking to cover all of your monthly expenses is to never interrupt compounding interest. This is where it starts to get a little bit complicated, but let me try to break it down as simply as I can. This is where I start to say to people, this is where words matter. People too often talk about borrowing from their policy. If you've ever asked yourself, how much sense does it make for me to borrow money from myself? The answer is none at all. Here's the good news though. You're not actually borrowing money from yourself. What you're doing is you're using the cash value and the death benefit inside of your policy as collateral, meaning that you're putting it up as a guarantee to pay back the loan from the insurance company. So here's the cool part. Because of the fact that you're not borrowing your own money, but you are instead using it as collateral to borrow from the insurance company or any third-party lender, your money continues to grow on a guaranteed basis. This is how you earn compounding inside of your banking policy. And this gets me to my next point, which in my opinion is the most overused and misused concept in infinite banking. The idea that you pay yourself interest. Based on how I just explained how policy loans work, it should make sense to you now that you can't pay yourself interest inside of infinite banking. Let me explain an example here. If I took a $100,000 policy loan as a down payment for an investment property, for example, and the interest rate was 5%, that would mean that I would have a simple interest payment of $5,000 at the end of the year. That $5,000 is not paid to you. If you pay that, it's paid to the insurance company. They gave you the loan, so you're paying them. Accordingly, some would say that if you're paying the insurance company 5% interest, but decide to pay yourself back 10%, you're earning an extra 5% as the bank in your policy. So once again, it doesn't work this way. Any money above and beyond the minimum interest due to the insurance company for the interest payments that you're making to them are going to go towards paying down the principal on the loan, which, by the way, is a phenomenal thing. When you do this, you'll have less interest due next year. Oh, and by the way, that $100,000 that you borrowed earned a return as well. Let's say that return between the guarantee and the dividend is 5%. That means you now have $105,000 inside of your whole life policy, plus whatever additional premiums that you would have paid for. But for the sake of simplicity here, let's assume your policy is paid up and you don't have to make any more premium payments. Otherwise, this is going to get a little more confusing. For the sake of it, you could continue making premium payments. You don't need to. Let's just say you're not needing to right now. All you made was the interest payment of $5,000. You would still have a loan of $100,000 due, and you'd owe $5,000 again the following year. All the while, your account value is now $105,000, and if you were earning 5% interest on that, you would earn $5,250, which is $250 more than what you started with. And this is the power of infinite banking. When you do this consistently and you follow the rules over a prolonged period of time, it works amazingly. However, you never pay yourself interest. I always tell people there are no free lunches. Some people try to tell you that you can get a personal policy, that you can lend money to your business, and in doing so, they say that you can pay the insurance company 5%, so your cost of money is 5%, and charge your business whatever percent you want. Let's just call it 10% for the sake of round numbers. In doing so, the business can write off the 10% payment on their taxes as a business expense. Sounds great, right? But here's the problem. If the business is writing that 10% off as an expense, then it must be income to somebody, right? Yep. The question is who? Well, the answer is you, the policyholder. So whatever expense you write off in your business will need to be claimed as income by you, since you are playing the role of banker to your business. And I guess that kind of answers portion of the tax deduction element of this. At the end of the day, it's not so simple. The benefit of tax deductions really comes down to your lifetime tax liability and benefit of that with a whole life policy. The real benefit is controlling your money now and paying your tax liability now when taxes are low and before the government increases them. If you believe that the government debt and poor economic policy will force higher taxes, then an infinite banking policy is a very attractive long-term strategy from a tax perspective. Now I have a lot more videos on this, so make sure you subscribe and you check them out. You can check out the Infinite Banking playlist as well, where I cover a lot of this stuff over and over again from a lot of different perspectives and angles. Okay, so now that I've sorted through most of the noise about infinite banking, you're probably asking yourself, why does Chris like this so much? He talks about it all the time, yet he seems to have a lot of issues with how most life insurance agents are trying to sell the concept, right? Well, like anything in life, you can have the best thing in the world, and unfortunately, humans are still going to mess it up. This is no different. Remember, infinite banking is just the marketing name for a conceptual strategy on how to use whole life insurance to give you more security, more guarantees, more opportunity, and more control with your money, period. Now, I don't know about you, but I don't know anybody alive who doesn't want all four of those things. And there's no other financial tool in the world that can do it. And while it not makes sense for you to run all of your expenses through your policy right now, it will eventually make sense as the policy matures. Remember that long-term view perspective I was talking about earlier? In the meantime, your policy will help you in so many other ways: major capital purchases, real estate down payments, business lines of credit, and so much more. Essentially, policy loan rates are extremely cheap compared to the cost of borrowing money for most business opportunities. Remember, there's always a cost of money. So anytime you can use the policy to lower that cost of money, which there will be many, make sure you do it. To take it to the next level, you can also use a cash value line of credit and use your policy to guarantee it in a similar fashion to the way that you use your home to guarantee a home equity line of credit. The great part is that the cost of money with a cash value line of credit is typically cheaper than the insurance company. Now, the only downside is that it comes with a minimal monthly interest payment that you have to make sure you can afford, while the insurance company loan is completely unstructured. Now, many infinite bankers don't like the idea of utilizing cash value lines of credit because of the first point that we talked about, which is trying to eliminate banks from the equation. But I'm a huge believer that you should always reduce the cost of money wherever and whenever you can. I understand the sentiment of eliminating the banks because the system is set up to systematically take from you, but if you can leverage the bank to enhance your financial efficiency, why not do it? It puts you in control. It's how you really become the banker, in my opinion, and you beat them at their own game. Now, let's talk about when it actually makes sense to run your expenses through your banking system from a mathematical perspective. As soon as you know with 100% certainty that the cost of money will be less than what you're earning in your policy to run your expenses through your policy, then you can do it. And the only way to do this is by utilizing a cash value line of credit. For instance, let's say you had a properly designed policy that was 6 to 8 years old. That policy will be growing by over 3 to 3.5% annually by then. And that's after all expenses and charges. When you break it down, that's about 30 to 35 times better than a traditional savings account. Now, if you could get a cash value line of credit with an interest rate of 3%, now it makes sense to begin running all expenses through your policy, through your banking system. I ask everybody I work with, well, when's the next best time to plant a tree? Right now, right? Think about it that way. It's the same for whole life insurance when you design it and leverage it properly. Now, I don't care what you call it, infinite banking, circle of wealth, bank on yourself, leap, cash flow banking, or anything else, and there's a bunch of names. It's all the same idea, and it all works as long as you use a properly designed policy and your expectations and strategy are in alignment with reality. You can't use Index Universal Life for this. You have to know that. If you haven't already, make sure you subscribe to this channel so you can learn more about whole life insurance as an asset to improve your business, your real estate investments, or just the overall financial efficiency of your personal life. If you have any questions or comments at all, leave them in the section below. I do my best to engage with every single comment I possibly can. If I see it, I respond. Until next video, have a blessed, inspirational day. See you next time.